All our depreciation examples so far have been for full periods. What happens if we buy an asset and only need to depreciate it for a part period? What do we mean? Well, let's have a look at what we've been doing. We've been doing straight line depreciation. We got this formula. So we got the expense every year equals the historical cost less residual value divided by the useful life. And we're taking an example, and let's just put some dates in now and say on the 1st of January 2023, a business purchased a van with the following details. The purchase price was $48,000. We had to modify the van so we could use it for $2,000. The estimated residual value is $10,000 and the estimated useful life is $4,000. So we plug all those numbers in. The cost would be the 48 and the 2, which is 50. Take out the residual value of 10, useful life of 4. So that was $40,000 divided by 4 years. That's $10,000 per year. And that's fine, because what we've been doing is saying, well, when I put this in the balance sheet, I'm going to have the asset ledger, which is the van, and I'm going to depreciate it for 2023, 24, 25, 26. And I'm going to put it under non-current assets, so I'll put that here, called van, and that will be, also need to report the accumulated depreciation, and that will give us the carrying value. So, if we took the van was a $50,000 van, so we would always report that at $50,000. That doesn't change. What changes is as each year goes by, we say the carrying value, the unused economic resources, we take out the accumulated depreciation. So in year 1, so the full period is in the whole year, we depreciated 10 grand. So that must have meant the carrying value was $40,000 at the end of 2023. In 2024, we used another $10,000 here, so we'd accumulated $20,000. So that must mean that if the carrying value was 40, take out another 10, the carrying value at the end of 2024 is $30,000. In 2025, we're going to depreciate another 10,000. So now we've accumulated 30, so the carrying value at the end of that would be 20. And lastly, we'll accumulate another $10,000 in 2026, so that's a total of 40,000 here. So we see 10, 10, 10, 10. So the carrying value at the end is 10,000. So that's what we've been doing. So that's nice and straightforward. I just happened to buy the car on the 1st of January, and then I depreciate it on the 31st of December. But what if we change one thing? That was when the business owned the non-current asset for the full period. So in this case, that was 12 months, but the period could be a month or a quarter or a half year, whatever it is. But the point was we bought the car and owned it for the whole period, which is before the next balance day. So this is what happened here. This is all the info we just had. What just happened? Well, we bought the non-current asset, just happened to buy it on the very first day of the period, and then a full 12 months went by before next balance day. So that was nice and easy. The problem here is, what about if we buy the non-current asset during the period? So let's change one thing. So let's say instead of the 1st of January, let's say the business bought this van on the 1st of July. So that's right in the middle here. Okay? So all the other info is going to be the same. So we're going to have our, our formula. But the problem with the formula is it says, here's the depreciation expense per year. Now, in this case, we're not going to own it for a year by the next balance day. We're only going to own it for 6 months. So we've got a problem. And the problem is, we need to take this annual depreciation expense and we need to turn it into a monthly rate. So we do exactly what we did. Depreciation expense per year, put all this in. We've got it to 10,000. And now what we're going to do is divide it by 12. And as soon as we divide it by 12, we now get it as a monthly rate. And you're going to get a lot of fractions now, like decimal points, which we hadn't done, don't really pop up. Usually when you get a decimal in accounting, you go, I've made a mistake. Not anymore. For depreciation, this is actually 833.33333 forever, right? That's okay. We can just round it. Don't worry about rounding up or rounding down. It's not material. It's not relevant. It's not going to change our decision making whether you write 833 or 834. So don't stress about the rounding. Okay, so now what just happened? On the 1st of July, we bought the van. So that's actually, if we look at 2023, which is our reporting period of 12 months, we didn't buy it on the first day of the period, we bought it here. So really, we don't need to depreciate for these 6 periods here. That's wrong. We didn't own the van. We bought it there, and then 6 months went by here, and then the next balance day happened, and that is when we'll need to calculate depreciation. And all we got to do is figure out how many months we're going to do it for. So we're going to do it for July, August, September, October, November, and December. So that is 6 months times $833 is $5,000. So you can see that that was for a nice 6 months. That's half a year. So $5,000 was half of 10,000. And with the rounding, again, don't stress. If it rounded up to 5,001 or 4,999, it doesn't matter. But we've got 6 months at $833. But What about if we just wanted 1 month or 3 months or 4 months of depreciation? Well, the formula works the same. All we've got to do now is our balance sheet and our VAN account. So we've got our VAN asset and our accumulated depreciation. So first of all, this won't change. We've still got a $50,000 VAN. Goes in here every year at $50,000. What's just a little bit different is we're saying the carrying value when we bought it was in the middle of the period here. So by that first balance day, we only accumulated $5,000 depreciation. So the carrying value at the end of 2023 is not $40,000 because we didn't take out $10,000 depreciation. We only took out $5,000, so it's really only $45,000. And now it actually gets pretty simple because we know that it's $10,000 per year. So for 2024, we're going to own the van for the whole 12 months. So that'll be $10,000 depreciation. So now we've accumulated 5 and 10. That's a total of 15. So the carrying value would be 35. Then 2025, a full year. So we depreciate the full year amount. So that's another 10,000. So now we've accumulated 25. So the carrying value is 25,000. And finally, another year goes by. It's $10,000 more. And then we depreciate it for a total of 35. And the carrying value is 15. Now there's still a little bit of this van left. We're not done with the van. It's going to continue into 2027. We're going to deal with that in the next chapter. What do we do with that bit when we finally do sell it? That's a separate topic. So for now, we'll just say sometimes this doesn't look like straight line depreciation. It doesn't look like it's all equal because it went from 5 to 10 and then it was straight line. But it actually is straight line. It just wasn't depreciated for the full period. So lastly, and this might never happen, but you might get on a saccharine exam, not even a part year question, but a part month question. So this formula works even when the asset is purchased during a month. So let's change another thing. It says on the 15th of July, 2023. So same details, but this time, not only did we bought it, so the reporting period is 12 months here. Not only did we not buy it at the start of the year, we didn't even buy it in the middle of the year. We bought it like halfway through this month here. So what do we do there? Well, we know we can divide the depreciation expense per year by 12 to get the monthly figure. So if we bought it halfway during the month, well, that must mean the first month's depreciation was actually only half of that, which is $417. And again, don't stress about the rounding. Round up, round down, it doesn't matter. But then every month after that would be $833. And now it doesn't matter what month we buy it in. If we buy it halfway during the month, we just get our monthly rate and divide it by 2. In this case, we just say for that first year, the depreciation was $417, and then it was $833 for the next 5 months, and it was a total of $4,582. So the main takeaway here is to always divide that depreciation expense for the year by 12 to get a monthly rate. And then it doesn't matter what months, how many months we ask you to depreciate it for, 1 month, 3 months, 6 months, 7 months, 11, or even half a month. You can always do it just by dividing it into a monthly figure.